Okay, welcome to the fall update, everyone. And title being interest rates cut, markets hit record highs. We're going to try to show whether this continue or not and where we think you ought to put brand new money now. Now, I'm going to remind everyone that in the spring, we had a call, and of course, it was in the period that there was a little bit of panic because we were officially down exactly 20% on the S&P 500. Stocks tumble. This was basically the theme of the spring update. Stocks tumble after Trump says long-term threat tariffs are coming. Of course, they have come, and yet the markets have shrugged that off and gone to new highs. During that call, there was a lot of talk about this is the next Great Depression. And of course, we pulled out the playbook because people were worried about the last time the tariff surged, and that was the Smoot-Hollings of 1928. And of course, then what followed was the Great Depression. And what we actually in our work showed is that there was other things going on. And up until 1928, tariffs were a major source of tax revenue to the United States. In fact, before 1913, it was the only source. There were no income taxes. So again, I wanted to say that I am not a big fan of tariffs, but we also are in the business of allocating capital. And so whether we're a fan or not of what the politics or the policies, we have to try to stay ahead. And again, we knew Trump was going to get elected, and we made a lot of changes before a lot of this stuff coming. He said, I mean, this was a campaign platform that was a promise, and he came with those promises. So we made a lot of changes beforehand. Okay, so here we are. Just a recap of the Standard & Poor's U.S. stock market 500 index. And you can see where we had our spring update down 20, and we've fully recovered, and markets hitting new highs. I like to do these calls because I tell you what's on my brain and what is relevant and what I'm thinking about. So just a few headlines here. U.S. economy grew at a staggering 3.8% rate in the second quarter, significantly stronger than previously reported. Now, again, second quarter is to the end of June. I was listening to an economist on CNBC. They're still looking for 3%, which is well above. So this is some of the strongest U.S. economic activity in quite a while. Now, again, you could argue that a lot of the second quarter was pre-running, trying to jump purchases of tariffs before they came in. But we're still seeing that continuation of fairly strong economic data on GDP side. Now, contrast that with Canadian. Canadian economy shrinks 1.6. 1.6 is a big contraction. Tariff squeeze exports. So the opposite of front running. It was almost let's do nothing, and a contraction in the Canadian economy. Europe grew at EU increased by 0.2, Eurozone by 0.1, employment by 0.1, some pretty stagnant numbers. So of course you expect the S&P 500 is the best place to put your money with all that strong growth, and well, not so much. Dow Jones up +9, the S&P 14. You can read these numbers. The S&P equal weight, which I find quite relevant because the S&P is losing its relevance as a benchmark because it is 10 companies that dominate the top or 40% of portfolios, and it's really not good portfolio diversification to have portfolios structured that way. NASDAQ up to 18, the Russell 2000 up 10, which is looking a little bit like the S&P equal weight. Canadian stocks up 21. Europe, so the one in recession is up 21, and the one in boom times is up 10. This is one of the most common errors people make is I think there's going to be a recession or the economy's booming and govern accordingly. Money has to go somewhere, and that can lead to growth, but at the end of the day, we're going to keep digging into this. The loser in the sector was government bonds in Canada. The winner on the fixed income side From the big areas is U.S. Treasury inflation bonds. And if you've been watching my channel or my calls for the last year, you know we love this sector. So this has proven that this is on top of the yield. So if you bought it at a 2.5 real yield a year ago from us, you got to add that on to the 5+% you're making. So pretty good for the low risk. Winner of the whole sector, it was gold this year, up 46%. And it's something, as you know, we've liked for quite a while, and we'll get into that in a bit. Why is Toronto stock market outperformed the United States? Well, in a nutshell, gold mining dominates TSX. And, you know, gold up 46. We have gold stocks up just over 100%. Just to give you a reference, we have 15 stocks in the Toronto Stock Exchange, which is just over 200 stocks. There is one stock in the S&P 500. So, well, the Toronto Stock Exchange is over 10% gold miners. The United States is less than 0.1% gold miners. So it almost does not play a factor at all. Hence, again, you can't say, oh, Canada's in recession, I want to be out. Well, in fact, the recessionary environment has created a boom for gold stocks. Why were bonds so poor performers? Well, a year ago, you said, I really think the Bank of Canada is going to cut rates. They'll pause and we'll start cutting again. This is a chart of the yield curve. And I'm sorry for all the people that have been long-term clients. We refer to this a lot. It's a picture of short-term rates and long-term rates. The blue line is 1 year ago. You can see that short-term rates in Canada have fallen. You think, oh, that's great for bonds. But you can also see where we are today, which is the black line. And you see the black line interest rates have fallen to about 2.5 on a risk-free Government of Canada 90-day T-bill. And all of a sudden, but the long-term rates have gone higher from about 3.2 to 3.7. And so as a result, bonds have dropped. Now, again, the good news, clients, is we own 0% in long-term government bonds, not a single one in our client portfolios. We do own a significant portion in the best performing fixed income, which is those Treasury inflation bonds. So, again, being proactive, you know, again, we're always trying to look forward and where is their bargains so far, so good. Maybe the most underreported story year to date is the decline of the US dollar. If you had said US is going to boom and Canada is going to be in recession, you probably would have concluded the Canadian dollar is up. Now, the Canadian dollar is up a smidge, only about 3% against the United States. The big move has been in the euro, which is the greatest weighting in the US dollar index. We call this the Dixie. It's a chart of the weighted to trade and currency relevance. So non-US dollar assets, US dollar being down about 12% against the euro. So, you know, again, if you go back to about 10% returns in the US stock market against poor Europeans that are invested in US stocks are negative for the year, unless they hedge their currency. Now, let's talk about US dollar. Is this the start of a major trend? Maybe, maybe not. Inconclusive on the technicals on that chart. You can see that the you know, Trump inauguration there, double spike, lot of euphoria and optimism on US dollar, but since US inauguration, US dollar has been quite weak. This is an important point. A 20-year chart, the United States dollar has not been particularly weak. It hasn't been particularly strong. It's up a little bit over 20 years. Is this the start of a US dollar decline? I think it could well be, but it's too early. I think the important point is currency diversification, because at the end of the day, I think it's risky, even as an American investor, to have all your eggs in one basket of US dollar. The world is not the US dollar. The world is a basket of a whole bunch of assets and currencies, and which is what dominates global capital flows into investments. We always talk about it. Money has to go somewhere. We try to get ahead of where the money might go, not where it's been. Um, this is the LePoidevin letter from 2004 back at National Bank. We talked about a new exchange traded fund was just launched. This is December 04, and it was launched in November of 2004, and the symbol was GLD, and it was a one easy way, rather than lining up, going to a gold coin dealer, getting certificates, you could buy on the New York Stock Exchange gold. We recommended this ETF, and we bought it for a lot of clients. We bought it at around 425 when gold was about 425. It's $3,900 today. We're going to go through that in a moment, but just there we were. And I have a very interesting chart, and I apologize if you can't see it. I'll try to explain it. The iShares, if you put your money in Vanguard, which is the leader of index notes, and you put the total return of the Vanguard total stock market index. So all stocks, what's the total return of the US stock market period, including dividend reinvestment? 20-year return, 658%, kind of well documented, we talk about a lot. Gold, 658%, exactly the same return of stocks. Now this is important because we had 3 or 4 questions that were identical. Stocks are high. Should we put our money in gold? Well, okay. They're both up 658%. So let's be clear, you're not buying cheap gold. I'm going to go back to this gold subject for a moment because it's kind of dominating and it's been the place to be this year. Gold prices adjusted for, this is in US dollars, but adjusted for inflation. This is a very important point because gold has maintained its purchasing power for roughly 5,000 years. This is important. You could exchange, 2,000 years ago, they said you could exchange 1 ounce of gold for 380 roughly loaves of bread. You could always, for the last few hundred years, you could exchange 1 ounce of gold for a high-end man's suit. It doesn't appreciate. It's that the US dollar, the euro, the currencies depreciate, gold stays the same. But in a free-flowing economy, gold will have periods where it goes up way above inflation, and then it will have periods where you revert back to a mean and goes down. So relative to US dollars and inflation, we just, and by the way, this chart was done just a few days ago. We're at 3,900 today. It shows 3,748. Gold, it has surpassed. We all know gold went from, $20 an ounce, 30. We were on the gold standard. It was fixed. I think it was fixed at 40. So it went from 40 to 200. Everybody piled in lineups to buy gold at Bank of Nova Scotia, who was the registered dealer. And, then of course it collapsed down from 800. There's the chart. That's inflation adjusted. We just passed that number. Let's measure gold on other ways. Let's measure gold to oil. You can see gold other than, and let's talk about when it was higher, gold relative to oil. Oh, COVID, okay? We stopped driving. The world told you to stay home. So that previous spike might have more to do with an oil collapse. But other than the COVID weirdness, gold relative to oil is the most expensive in history. Let's compare it. Copper is an interesting relation because copper is an industrial. It doesn't tend to be hoarded for value because it is expensive and big. When you buy hundreds of thousands of copper at $5 an ounce, it's hard to put it somewhere, but it does have massive industrial use, predominantly still in electrical wiring. There's quite a bit of EV use too, but you can see the copper has done very well, but gold has just surpassed relative to copper its all-time highest level. So we talk about gold, and I want to I want to make one point here, and that is this is not, I'm not here today to tell you that gold has peaked, that you should run for the exit. One of the guys I respect highly is a friend of mine. He's retired from uh, um, Haywood Securities, probably knows more about gold than anyone in Canada. And, his valid point is because we are at these massive debts and because there is this underlying fear that gold will stay elevated. And that's a very relevant point. But are we getting a bargain? When LePoidevin said in 2004, you should own gold. Now look at these charts here. Look at the early 2000. Gold was a inexpensive, underappreciated, undervalued asset. It has no longer got that value today. One of the other relevant points is that there's a class of investors that was creating, quote, they call it the new gold, which was crypto. Gold is outperforming almost all the major cryptocurrencies this year, which may mean that it's sort of more accepting of young people or assets. So again, I'm just giving you the relative valuations. Personally, for clients, we are reducing our exposure to gold. We've been there for 20 years, but reducing new clients. We're really not jumping into this asset. Again, relative other commodities, oil is way cheaper than gold on a valuation basis. Let's talk about money has to go somewhere, stocks. The trailing price earnings ratio. This is irrelevant. The higher the price to earnings of a market, the more you're paying for every dollar of earnings. This is trailing 26 times in the United States. This is starting to get to 2000 levels, people. Canada 19. European zone is high, a little bit high by historical standards. These are not projected earnings. We're looking at about 16 times projected, about 23 times in the United States. The world is no longer cheap, but if we look at, and again, this will be a little bit complicated. So if you don't follow what I'm saying, just fast forward for the next 2 minutes. The more relevant number is the earnings over price, and that gives you a yield. So if we bought every stock on the United States and we looked at how much profits we're getting relative to the price, all the profits we bought every company, we'd have about a 3.8% return, our profits relative to our price. That's the opposite of price earnings. It's earnings to price. And when you compare that against a treasury bond like the TIPS, which are yielding 5, or a fixed treasury bond at 4.1 midterm bond, stocks in the United States are getting relatively expensive. When we owned stocks of bonds in the 90s, bonds were cheap relative to stocks, and we've gone back there. So at the end of the day, it's okay to own some fixed income because stocks are expensive relative to many fixed income assets. Now, in euro, let's say we want euros, and let's say we're worried about having all our eggs in Canada or US. The euro area on a earnings to price yields 5.9%. And that is compared to the risk-free rate of German 10-year bonds at about 2.75. So you are the flows. We want exposure to the euro. The cheapest assets to own in Europe are stocks. This is a very important point. It has guided us in the 90s when we had very few stocks. We owned bonds, and at the end of the day, it's guiding us today. We want exposure to the euro. Stocks are cheaper. You say, "Oh, Europe's not growing." That's okay. The profits are growing, not massively. But at the end of the day, you can't count on massive profit growth at all times. Alex, can you close that blind? All right. We mentioned US stocks being expensive on a price earnings ratio. I want to talk about sales, just price to sales, because earnings can be volatile. They've been very good. Price to sales, United States at its highest level over 3.3 times. If we look at just recent history, Last 10 years, we can see that the average of the stock market is 2.4 times sales, which would put the S&P, which is at 6,600, down to 4,800. You can do the math. Stocks are expensive relative to earnings, are expensive relative to sales. You know, one of the things that people mistakenly do is they take stocks that have gone up dramatically and they say, well, stocks are going to make me 10%. Since the dawn of time, the S&P has returned 7% plus 2 or 3% for inflation. Therefore, I'm going to make 9 or 10. But there's periods of time where if you buy something at a premium, you should expect lower returns. If you buy something when the sky is falling and you're getting a discount, you should expect higher returns than the mean. It's not a new paradigm of growing forever. I want to point out, we just did gold on a valuation relative to its inflation. I want to point out the S&P 500 relative to inflation. This is a very important point. Stocks do not always exceed the value of your money. Sometimes you won't keep pace with inflation. I want to point out 2001, if you bought the S&P 500 on the value of the S&P, you only broke even in 1950, 49 years. Now, again, it's not as doomsday as that. You probably made it 2.5 or 3% dividend yield. Okay, so that's a long period of time for pretty low returns. 1968 to 1990, 2000 to 2017 at the bubble peak. Now, you can also see that after inflation, we really have only seen these kind of returns in the roaring 20s, 1980 to 2000 through that bubble top. We kind of feel like this sort of elevator, this is a logarithmic scale, so it's fair. It doesn't parabolically move up. So at the end of the day, I want people to lower their expectations. It's quite possible the S&P is not a great investment for the next 5 or 10 years. This is not, again, like gold. I'll tell you the playbook. Here's the problem. The US Fed has been cutting rates. Money has to go somewhere. If you've been parking your money in cash for most of the last year, you've been making 5%. The Fed cut it a couple times, moved it down to 4.25%. And recently, if you were happy with 5, there's a subset of people that will not be happy as we cut again and we go below 4%. And we get down to 3.5, which is where the market is forecasting rates will move to. So at the end of the day, money, the playbook as the Fed is cutting, don't fight the Fed, is that capital will move away from cash into other assets. What I'm pointing out is the S&P may be a riskier place than some other areas. The Russell 2000, we call that, Americans call it small caps. If we call these from a Canadian European standard, people, this is $1 to $10 billion companies. These are not small, insignificant companies. They're quite large and they trade plenty of liquidity. And so there's no problem buying and selling. I want to point out, stocks are at an all-time high. Here's an index that just back to its level of 2021. This is shocking. Europe, we've done really well. That was one of our major themes of Europe this year. Again, remember that year to date, 27% in Europe. That's in US dollar terms. The market's not up 27. Half of that return is we've made money on the currency. If we go back, this is a 20-year chart of Europe. We are lower than 2007. Now, again, when we started buying Europe, we made sure we bought a hedged currency to the US dollar. The euro was 160 back then. It's 117 today. It fell below 100. It's back briefly. It was about 103 to start the year. Are we going higher? Most probably in the Eurozone. And it's not that Europe's great. It's that the debt, people have fear of the direction of the United States. So are stocks expensive there? Are they at all-time highs? No, they're not at all-time high. The Russell's not at an all-time high. Europe's not at an all-time high. So let's not just, the market's at an all-time high. The market is not. The S&P 500 is, led by 10 stocks. Okay, so let's talk about other areas. There's stocks, there's gold, the bond market. This is something that is really one of the driving forces. We showed in Canada how rates have gone up. In the United States, rates have gone down a smidge. But at the end of the day, the bond market has been spooked by the big, beautiful bill, which took the US deficit to 6.5% of GDP. Absolutely unsustainable. Alex did a study of the current deficit where at a projected rate, Alex, what was the year that it would at current trend, it would consume 100 cents of every tax dollar on the interest?
Well, by like 2040.
2040. So at the end of the day, this is spooking the market. And it's why at the end of the day, the US dollar, which was, US exceptionalism, turned into US fear of holding all your assets in the US dollar. This is a chart of US inflation. And, the norm is that you lose money in your currency. We've gone from post-war 1945, $20. It takes $320 to buy what $20 buy you. You can see this is not a logarithmic. It would be much better if it was a steady, like 10% is 10%, but it isn't. But so it always looks like it's a parabolic move. At the end of the day, there's a constant printing of money and there's a constant devaluation of currency. You can see 2009, there was a smidge of deflation and there was a smidge of deflation under COVID. Ironically, as Jim Grant from the Grant's Interest Rate Observer states, there's nothing as inflationary as a smidge of deflation, because at the end of the day, they print money and they make sure that deflation isn't the outcome. So the norm of what we've learned is that inflation is constantly gnawing away at the value of our wealth. The interesting thing is, in the United States, we're on a trajectory that is unsustainable. And before I go into this, I am not the fan. I studied economics. We studied comparative advantage, but money has to go somewhere. The Economist, Trump tariffs, very significant source of revenue. Let me talk about the silver lining. Again, not a fan, but let's talk about the silver lining. We're already looking at annual revenue. Trump, because he's the president, he does not have the power of taxation. That belongs to the US Congress. The United States does not have that power. So he can't put it in the budget that there's going to be a big significant source of tax revenue, because they're not allowed to call it a tax. Again, they go after Canada and Mexico because of the penalties for fentanyl. Okay. All kinds of excuses, but at the end of the day, we're already looking at 350 billion, and that might be far shy. So at the end of the day, we are looking at a deficit that is far less than the headline, so it isn't as bad. And maybe, I always thought the United States could solve its deficit problem with what they have in Europe and what they have in Canada. I'm not a fan of taxes, but I'm also not a fan of deficits. At the end of the day, it's borrowed money. It's like a household borrowing. You got to pay it back at some point. But I always thought, if they had a value-added tax, like VAT tax in Europe, we call it a goods and services tax. If you put a tax on consumption, you would solve that problem. Well, in the United States, I would prefer a VAT tax because it creates a level playing field. At the end of the day, this is a VAT tax. It's a GST on all imports. Okay, so at the end of the day, it is bringing in revenue, and the U.S. deficit may be actually going in the right direction. I want to contrast this with Canada. Okay, we entered an election this year. The Liberals won after Justin Trudeau stepped down. So we re-elected the centrist party. who had moved way to the left, and the centrist party has moved significantly to the right. Again, federal budget watchdog forecast sharp rise in deficit. The Trudeau deficit was 39 billion. That's when they went into the election. Carney came out just after the election and said, well, it's more like 60. Now they're actually saying, well, it's 68 billion. The C.D. Howe Institute did some reports, and they say because we haven't had an economic update, we will on November the 4th. But at the end of the day, their numbers are 92 billion. Hold it. We are now starting to get to the Canadian dollar's risen because our deficit at a government level, it looks reasonable, but it is the United States is going the right direction. We are spiraling into the wrong direction. We're looking, C.D. Howe did some numbers and said, if we meet our NATO commitments and the fact that tax revenues are beginning to implode, and I'm going to go through this in a moment, we could be looking at deficits in Canada of 200 billion, which would be almost doubly bad of the United States. And that's a scary point. And we're getting a budget on November 4th in Canada. Canada should be ready for generational investment. Code for deficits, in my opinion. We'll see. We'll see what investment makes, but that sounds like spending to me. Now, why is Canada's deficit with no new spending, why is it spiraling out of control? And that's because we have a value-added tax. And at the end of the day, value-added taxes are based not on income, which tend to be fairly consistent, but based on consumption. And the problem, and my son Alex did an excellent report, it's on our website, on currencies. And one of the things that we look at is Canada's not government debt, but private sector debt. These are mortgages, corporate debt, lines of credit. You can see that all told, Canada's at 212. Next highest is Switzerland, which has had very low interest rates for 100 years, backed by gold. United States is 145. That's a big difference, 212 in Canada. The euro area is 78. Debt to GDP outside of government debt. And this means that Canada is very, very vulnerable. And what the implosion of debt is caused by is predominantly a collapse in housing activity. When house sales are down almost 40-something%, there's less land transfer tax, and a new builds the GST, the PST. So we have value-added taxes at the provincial level, at the government level, and every $1 million condo. We have land transfer taxes in Canada, which they have in some states, but most do not. So at the end of the day, this is what's happening, and this is why I'm concerned about the direction of Canada. Toronto has a record number of months of supply of people that bought investment properties in the greater Toronto area, GTA, that are trying to get out before they close. And this number has gone parabolic, 60 months, 5 years of inventory. Houston, we have a problem. Prices of condos are being reflected of the supply and demand imbalance. This was just a few weeks ago. This is was really a bit of a shocker that shouldn't be swept under the rug, but there's a Oakville 30-something story tower that had a number of units not close. They put their 20% down and they have walked. Now, again, you can sue them, but if you're a numbered company that bought it and you're out of the country or maybe an immigrant, there's no one to go after. So at the end of the day, this was marketed and pre-sold for $1,100 a foot. They decided to blow them out at $635 a foot. The other developers are irate. Oakville, by the way, is between Toronto and Hamilton, call it a suburb area. Irate other developers because $635 is like kids trading baseball cards in a schoolyard. Well, what's that card worth? Well, Joey paid X for it last week. But that becomes the new benchmark price. So now all of a sudden you're looking at condo prices down 40+%. And, this isn't reflective. But where we are starting to see the declines is in a lot of the outlying lenders. And there's a outfit called Fortress. It was just in CBC News recently. What they were doing is valuing, they were marketing the investment as being very, very low risk because it was a low loan to value. Well, they valued the investments based on where they projected the price would be once they completed development, not where the price of the value of the, so they took record high prices and they project them way higher and then claimed a very low value. It's just, you can watch the CBC on YouTube. It's called Fortress. People are going to get back well under 10 cents on the dollar. Now, this was 900 million. This has created reverberations. And the reverberations are people are getting worried about this as an asset class, and people around the world, we have billions and billions and billions of dollars into these lending institutions or real estate funds. Tres Capital, one of the biggest in Canada, suspends investor redemptions. Everything's fine, Mr. Client, but you cannot have your money because at the end of the day, they don't want to sell anything. Dear valued clients at Kensington, this is private equity. We are not going to allow you to have your money. People need their money. If it's more than 5%, they just don't have the reserves to pay you. Nicola Financial, Centurion real estate fund changes amid surging redemption requests. This is very interesting. Nicola Financial is the one that I've been talking about in my calls, and I didn't say him by name. I didn't want any lawsuits. At the end of the day, they manage 17 billion in Canada, and there's a lot of people I know that have invested. Some of our clients have some money with us, some there. Really became a dominant player. They originally were just mutual funds and they were equities, and they were pretty good at it, actually. Good asset allocators. Not a fan of mutual funds, but they were decent at it and very good financial planners. They morphed in bigger and bigger and bigger into their own real estate deals. Now, on the left, you can see Nicola's real estate, what they call value add real estate. And they really couldn't deny that there were losses in the fund. So they marked it down by 20%. The big losses are coming from development. Again, they had no experience there. Just everyone else was making money, but the real losses were in multifamily condo developments in Vancouver area and suburbs that clearly the units are being marked down. So they couldn't deny it. The auditors wouldn't sign off on it. But I want to point out something very interesting, which is their flagship real estate limited partnership. If you look at the chart here in the cumulative returns, you see that the net asset value has not really gained a lot, but it's at an all-time high. So they're valuing the Canadian real estate portfolios at the highest level that they have ever seen. In other words, things are really, really good. Couldn't be better. We have the highest value we ever have. This is the Globe and Mail. So this is not my projections. This is Globe and Mail. Nicola Wealth told investors on Wednesday that it would be reducing monthly dividends, distributions, and that it would delay redemptions. Well, they're very quick to say, we're not gating it, but if you want your money, we'll decide how much you can have and when. John Nicola, the firm's CEO, chairman, and chief investment officer, told the newspaper this was because too many investors were simultaneously looking to withdraw money from their funds. Okay? This is the clincher here. It's been a challenging market for investors. The firm believes that now is a poor time to sell real estate. Investors should be patient at a minimum, wait for stronger real estate markets before reevaluating a potential sale. There's a strong case and the glass is half full. Wait a minute. You've said on the valuation of your fund that things have never been better, that we're at all-time highs. And then you say, well, you're stopping redemptions. You don't want to have people money because you don't want to fire sale. You don't want to sell the assets at a poor time. So which is it? Look, I've helped a lot of people withdraw capital from this firm, Nicola. If you have money there, I urge you to get in line, and I would urge you to contact us to make sure we help you, because we have moved a lot of money out of this fund. And congratulations if you're one of the people that got out, because I think your money's going to get stuck, and there's a potential that they have to write down more of their funds. So just be forewarned. This is a letter that we wrote. Again, we showed you the gold recommendation. We also recommended in 2007 in August that the United States was going to have a credit crunch. And we talked in the letter, it's on our website if you want to read it, but we talked in our letter about the cracks in the subprime market. Now, again, this was August of 2007. And I can tell you that for the next year, stocks went up and up and up. In fact, it peaked in about 11 months after we wrote this article. Subprime was a small subset of the United States market, and it was having limited effects on the market. But at the end of the day, we talk about, Bill Gross did a story back then, talked about the plankton theory. And eventually in the ocean, if the plankton dies because of the food chain, eventually the sharks will die. And I would say there's a good chance that all of this capital, that is all these Trez capitals, Nicolas, which were really just getting flooded, Capital Direct, Alpine Credits, all these lenders of money that were tripping over each other to make builder loans and subprime real estate loans. The crack in subprime means that the uncreditworthy investors were having trouble getting money. Plankton theory. This is what is it's happening now. It's the start. We have seen Canada's subprime moment. Again, you could say, David, you've been talking about the bubble in housing for years. We haven't had the catalyst. I talked about in the United States for years. 2007 was the catalyst. We have the catalyst in Canada. Okay, one more talking point here. This is very important. When we're looking at fixed income, when we're looking at assets, we don't love to pay full price. We like discounts. We like buying things at a bargain. This is just a couple of weeks ago, Great-West Life announced a new preferred offering paying 5.7%, which is 2% above the long-term Government of Canada bond, risk-free bond. Great-West Life's a very high credit quality company. It makes a lot of sense, but it's investing at its full price of 25. If the company doesn't want to continue, they can pay you back in 5 years. So you make 5.7%. I want to talk about the experience of buying preferreds at less than full value. You can see that Enbridge Preferred F, which is a better piece of paper than the Great-West Life. Great-West Life was 2% above at 100 cents on the dollar. Enbridge F, for Frank, preferred, is a deal of 2.5% above. Now, the Enbridge is 2.5%, and it rolls every 5 years. And when rates collapsed to zero, people got spooked. But you can see that instead of buying our clients, we bought no preferred shares at 25, and in fact, they went up $1 above because it was so good. We did all our purchases down here at 14, 15. COVID, we even bought some preferreds at 50 cents on the dollar. When you have fixed income, the experience, we had a lot of clients that my friend told me that preferred shares are terrible, to be very, very careful. Oh, the friend bought it at 25. You bought yours at 60 cents on the dollar. You have a totally different experience. If you bought this back in 2014, you're still upset. You look at your account, you're furious. If you're my clients and you bought this at $14 and it's trading at 21 today, you're thrilled. You've been collecting a huge dividend. The dividend's gone up. And by the way, it's still a bargain because the dividend was just reset. It yields 6.5. And relative to GICs, you get a dividend tax break. It's equivalent to earning 9% on a GIC. This is probably going to go back to 25 because it's still at a discount. Very important point. So, last point here, Treasury inflation bonds. I'm going to show you a chart here of the yield of 10-year Treasury bonds. We just showed you that gold and stocks do not always beat inflation. You could go sideways for a long period of time. This is going back 2005 on the rate of return on Treasury inflation bonds. You can see from 2010, 2011, up until just recently, 2023, you got -1 to +1 was the price people would pay for a real return bond. We're back. The longer end is over 2. We did buy a lot of the midterm bonds at over 2. You can get close to 2. The longer end is over 2. And this is kind of the exciting part. Somebody who bought this bond, it was issued in 2022, Treasury inflation bond at 0.125%. They paid $100,000. They're willing to sell their bond for $54,000. Now there is an inflation factor. I can go one-on-one, explain it to you. For a 2.48% yield, like someone else, we bought our Enbridge preferred at 55 and 60 cents on the dollar. When we can be in assets like preferreds, like treasury bonds, when you can be in fixed income and make money on top of your running yield, it's magic because you haven't taken a lot of risk and you're in fixed income. So at the end of the day, a great place to be. And again, I'm not terribly afraid of value stocks here. The Russell 2000 value index is trading at just 14 times earnings, but we can own bonds. And it's not because we're chicken littles, it's because this is going to be a moneymaker. And there's a good chance that the stock market does run into some problems in the next while, probably within the next year. Money has to go somewhere. This is pretty darn good deal with someone selling at 54 cents. Is it going to 100 cents? No idea. I doubt it. But 54 cents on the dollar to 70 cents on the dollar while we're earning 5% while we wait. Wow, that's good math. Themes of today are value, fixed income at a discount, gold, not a bargain anymore. That's kind of the questions. Once again, if I didn't get to your burning question, let me know. I've talked for way too long, but there was a lot to cover. It's been a while, and markets are at highs. Major theme: stay the course. We're always proactive in our accounts, and we don't just sit idle. Our competition, 60-40 zombie portfolios, we're always being proactive. And when the markets get tough, I think that's when the LePoidevin Group shines. Okay, thanks everyone, and we'll hope to hear from you soon. Okay, bye now.